Hi, I'm talking to Leah Smith with Guild Mortgage. Leah is a loan officer and excellent one at that. And since I know there's questions about investing in properties, I thought we'd talk to Leah about the best way to do that for individuals wanting to get started. Hey, Leah.
Hi, how are you?
Very good. So my first question to you is, if somebody's trying to get into investment properties for the first time, they want to get a little rental, get started, what's the best way for them to get financing they've never done it before?
So if they currently own a home, then they're more than welcome to go ahead and get an investment property. Even if they don't own a home, they can go ahead and get an investment property. There are loan programs where you can do a 2 to 4 unit property and actually live in one of the units and still be able to count that income that it's getting from the other units against the mortgage to kind of help you afford that. But really the best thing to do is to just make a loan application so we can see your current financial situation and then also assess what money you have saved. Because anytime you're looking to purchase an investment property, you're going to need more down, usually 20%, but 2 to 4 units can be as much as 25% that you'll need down into those. So really, it's just assessing that financial situation. As soon as we have that down, of course, you'll want to talk to a very well-qualified realtor, such as Richard, who can help you find, yes, not only find a property, that's only half the battle. You want to make sure the property is making you money, it's in a good area, you can get a good tenant in there, and that's where that realtor will step in and really help you assess the property after you have the financial piece down.
Sure. In fact, this is actually a break in my series of 3-minute real estate on YouTube because we're going to go longer here, obviously. But
Yes.
that's what we do is we talk about something a team, getting your advisors in different areas, insurance, real estate, financing, and then we've talked about how to evaluate those properties. You mentioned that you could do it either having a home or not having a home. What kind of difference does that make in terms of financing?
So really, it doesn't make that big of a difference. However, if you've never owned a home before, it can sometimes impact if we're able to use a property that already has a tenant in there. So the rent that they're paying, it does impact whether we can count that against the mortgage payment. So it could impact what they qualify for if they don't have a home that they're already paying on or any sort of rent that they're paying. From a non-financial piece of this, just personal experience with anyone I've seen that's owned an investment property, I feel like it's always better to own your own home first. So you really know what comes with the maintenance, you know what comes with making those mortgage payments, tax payments. So you're really prepared all around to have a tenant and be a great landlord, because we need more good landlords in Kansas City. We certainly do.
This is true. This is true. As far as you mentioned, 20, 25% down, is there a difference as far as based on, what is that based on? Is it based on the property? Is it based on your financial shape? What would be some of the things that would determine how much you need to get down?
So really the biggest thing is just going to be based on the property itself. If you've got 2 to 4 units, you're going to need the extra 5%. So you would need the 25%. If you just have a single family property or a condo, you're looking at the 20% down.
Okay.